Good morning and welcome to this Monday, May 15th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it is now mid-May. Of course, some of you that follow my work know that the first half of calendar months calendar quarters tends to be better than the second half of calendar quarters. And so today technically is the last day of the first half of this second calendar quarter. So that's one thing maybe that we need to at least keep in mind. Second half, again, doesn't perform nearly as well as the first half. I don't have the numbers in front of me, but it's a pretty significant decrease from what we typically see in the first half of a quarter. And that's where we normally are building in earnings. The market tends to have pre-earnings rally for the 2 to 3 weeks leading up to the actual start of earnings season, which is normally around the first, well, probably about the second end of the second week of the first calendar month of each quarter. So January, April, July, October, normally, based on all the historical research I've done, we tend to see the market perform better than it normally does throughout the year during the 3 weeks leading up to the middle of each of those calendar months. So we've already gone through that. We've had we had the big rally at the beginning of the year in January, of course, that was heading into earnings and then throughout earnings season. Hasn't been quite the same in April, and I think part of that was because we had a nice rally at the end of March on the S&P 500, and since then we've just kind of been holding steady, consolidating. Of course, the large cap stocks have led the Nasdaq up, and the Nasdaq's continued to put in some new recent highs. But the S&P 500's last high, its most recent closing high, was all the way back at the beginning of February. It was on February the 3rd when we closed at 41.79. So we'll be looking at that chart in just a little bit, but we've still got work to do. I guess that's my point. And we've got to do it in a period when the market tends to not do as well. It doesn't mean we can't go higher. The returns for the second half of the second quarter are positive. I'm not trying to say, hey, we're going to head lower because it's the second half of the second quarter. It's just that the returns historically have not been as great once you get through earnings season. And from a common sense perspective, that kind of makes sense to me. I mean, once the news is over, what's there left really to trade off of? Now it's the manipulation. It's, the big Wall Street firms getting in position for the next quarter. And so you got to deal with that. So I wouldn't expect, excuse me, based on history, anything to, for us to go soaring. But some of my indicators do say that growth stocks should hold up pretty well. So that's kind of what we're dealing with. That's kind of an overview as we head into the second half of the second quarter. This morning, we've got futures looking pretty decent. Dow futures up 52. S&P 500 futures up about 9. NASDAQ futures up 31. Seeing a little bit of strength, relative strength on the NASDAQ. Crude oil futures back up over $70 a barrel. They're up about 0.5% this morning. And the U.S. 10-year Treasury yield up 3 basis points to 3.49%, still in the middle of a pretty wide trading range. So that's kind of where we're getting the week started. Let's go ahead and jump into what happened last week. So to close out last week, the Dow Jones Industrial Average down 9, S&P down 6, NASDAQ down a little bit more on a relative basis, down 43, mid caps down 0.5 point, small caps down 3. So everything was down, but we did have a nice rally late in the day that cut the losses. The only real problem I saw with the action on Friday was simply that we had leadership. You can see utilities up 0.5%, staples up 0.4%, real estate up about 0.2%. Same goes for materials. And notice with that big rally on Friday, none of our aggressive groups were leading. But for the week, we actually had pretty strong leadership from the aggressive groups. Communication services and consumer discretionary were the top two sectors last week. So we saw a little bit of maybe profit taking in some of those areas as we closed out last week. And we saw money rotate into defensive areas, but it was really on a ho-hum kind of a day. I don't really take too much out of that. And like I said, earnings now, pretty much slowing down and out of the way. We've had the jobs report. We've had the Fed meeting. We've had both inflation reports, CPI and PPI. So it's like, okay, now what? And I'm not really sure. I think, maybe the market will anticipate something. So that's what we'll be watching for. If we do move higher or lower, let's look to see what leads to the upside or to the downside. That can help give us some clues. But primarily, we'll be looking at the bond market, see what's going on there, and then just overall technicals. We know historically, I've talked about this, historically, growth stocks love these next 4 months, May through August. This is where growth gets all of its outperformance, large cap growth. This is where it gets all of its outperformance for the year versus value stocks, May through August. And yet, listen to the CNBC folks and all the media, go away in May, go away in May. Really? Growth stocks get all of their outperformance May through August. Yet we're supposed to go away in May. Get technology. Some of the aggressive groups really like the summertime. Semiconductors. Let's just go up and take a look at semiconductors here for a second. This is the seasonality. And if we go back the last 11 years, which is since this secular bull market started, look at the month of May. I mean, they're telling us to go away in May. That's what media wants us to do. Go away in May. 91% of Mays since this secular bull market began in 2013, semiconductors have gone higher. That's, if you want to do the math, 10 out of 11 years. And they've averaged going up 3.8%. The only better month throughout the year during this secular bull market for semiconductors has been November. And yet we're supposed to just go away in May. Ignore that. That's the problem I have sometimes with these slogans and the way that the media portrays all of this. It's, their overall comments are generally true, but they ignore so much bullish information over the summertime. And so it's part of the reason why I'm here. Try and set things straight, let you know what really is going on. All right, 10-year Treasury yield. This morning, you can see 3.49, almost 3.50%. We're up 3 basis points, but still overall in a downtrend, really just consolidating for the last 6, 7, maybe even 8 weeks. Trading mostly between 327 and about 360, maybe a little over that, 365. And here we are at 350, almost sitting right in the middle of it. I mean, if there's one technical thing to watch is maybe the 50-day moving average, because it's been literally 10 weeks since we've actually seen a close of 10-year Treasury yield above that 50-day moving average. So we're right up there. Are we going to roll over? Are we going to break out? That would be something in the short term to watch, maybe as a directional clue for the stock market. The 10-year Treasury yield starts moving, breaking out above some of these recent highs. That could put a little bit of a, I don't know, maybe a little selling into the stock market. If, on the other hand, though, we roll over and start moving lower, that could be a major catalyst for those growth stocks. And remember, this is the time of the year when these growth stocks do well. So if they got a catalyst like a lowering of interest rates, the 10-year Treasury yield, that would be potentially a big catalyst to send growth stocks up even further, which would be good news for the NASDAQ. All right, talking technically, looking at the S&P 500 here. 41.79 I mentioned earlier. That was the high back on February the 3rd. And that's right there. Excuse me, February 2nd. 41.79.76. That's the number. Short term. That is the number I'm watching. We closed Friday at 41.24. We're 55 points away. That's about, I don't know, 13% or so. Or excuse me, 1.3%. Got to work on my math there a little bit. 1.3% away from a big breakout level. It wouldn't take much. One decent day by the S&P 500, we could break out. To the downside, though, there's not a whole lot of room down to 40.50, which is a key short-term support area. That's 74 points. That's less than 2% away. So we've been in this range now between 40.50 and 41.79 on a closing basis since the end of March, since we had that huge run. And there are some who are saying, hey, this is not good news. We've made a move up, can't get through resistance, probably going to roll over. Honestly, I think of it quite a bit differently. I mean, I look at this anytime you get a big move up, what you normally see in a downtrend when you're moving lower. Let's stretch this chart out a little bit. Let's go back a year and 6 months. Take us all the way back to the beginning of the cyclical bear market that began in January 2022 right here. I mean, one of the things you see when you go down and then you rally, the rally doesn't last long. We roll right back over. Here in end of March 2022, a lot of folks thought, okay, we've taken out the February highs. Okay, that's over. That little pullback's over. And we ended up going up, failed, came back down. Look at this. We go up. We pause up here maybe for about a week and then right back down again. Here we go up, right back down again. Do you see any big movements up followed by a lot of sideways action and then potentially a higher high and higher low going in? That was not what we saw in 2022. Strength, when it would end, it ended. And back down we went. The whole makeup of the market in 2023 has really been a lot different. Here at the end of 2022, we made the move. We pulled back, but we held way above the low in October, and we broke to a new high. Now, we haven't broken to another new high yet, but we also have gone down and held that low. So when you're wondering, okay, where are you getting this 37.75? Because I've talked about this level in the past, along with the 41.79. That's based on this low down here. We've got a higher high, or we've got a high, a higher low, and then we've got another higher high. That's the beginning of potentially an uptrend. If we break out above 41.79, that leaves us with yet another higher high and another higher low. Higher high, higher low, higher high, higher low. Breakout would be another new higher high. Very bullish in my view. But this sideways movement after a rally, to me, this is like, call it a flag. To me, it's a bull flag. You can call it rectangular consolidation, whatever you want. But to me, it's a flag pattern. You had to move up. That's the flagpole. And then it's just waving. This is the sideways consolidation. And if we hadn't gone through what we'd gone through in 2022, and I didn't know what the weekly chart looked like, I would say there's a really good chance this is breaking out to the upside. And I still think there's a really good chance it breaks out to the upside. But I'm also aware of that bigger picture where we haven't yet established a break of the series of lower lows and lower highs. Here's the weekly: lower low, lower high, lower low, lower high, lower low. And that's it. We have a lower high here and a lower low here. In order to reverse that downtrend, we've got to get through 4,300, 4,305. And so we still got not only the short-term 41.79 level to get through, but then we've got a really big level on the weekly chart at 4,300. I would argue this is the biggest level. It's also that August level where we sold off after the infamous Fed Chief Powell speech at Jackson Hole. Remember the more pain ahead speech? Always like those. Little sarcasm in there. But you got to love it when Fed chiefs try to be traders, try to tell you and try to give you some market guidance. Again, saying that tongue in cheek. I always think back to when Greenspan in 1996, Greenspan, the irrational exuberance. Remember 1996? We could go back and look at that chart. I think it was in the summer of I can't remember exactly when it was. But if we go back 30 years on this monthly chart. So here was 1996. It was somewhere right in here after this steady increase from 95 to mid 96. I'm pretty sure it was over the summer. And he said something about this is a market of irrational exuberance, suggesting that the market was topping, was too high. And then we went on after he got done to one of the most significant rallies in the history of the US stock market. If you're looking for market guidance, don't go to the Fed. They're brilliant people and they know their job really well. They don't know the stock market. Not from a technical sense, not from calling it tops and bottoms. Ignore them. They're not a whole lot better than the media. Keep in mind too that the Fed has a kind of little bit of an agenda when they talk about the market. I mean, Fed Chief Powell back in August, he wanted the market down. And it was pretty simple. When the market goes up, people feel wealthier and they spend. With inflation, the Fed wanted everyone to stop spending. They wanted to cut back on their spending, cut demand. So supply could catch up and we could get through the inflationary period, bubble, whatever you want to call it, that we were dealing with. So there was a little bit of an agenda there. So how much of it was the Fed wanting the market to come down and how much of it was him believing that actually prices were that we were overpriced and we were going to go lower? I don't know. We'll never know. But just understand they do have an agenda sometimes to get the public to do what they want them to do. And sometimes talking about the market can do it, or at least they try. NDX, this is the NASDAQ 100. This is where I was saying we keep breaking out. Notice this February high. We've been trading over the February high for the most part the last 7 weeks. Little different picture than what we've seen on the S&P 500. Remember, NASDAQ's more growth oriented. So here's that growth coming through already in the month of May as we break out on the NASDAQ. And when we look back to the S&P 500, of course, there is no breakout. We're actually trending lower. So we're seeing that disparity in performance from May to August. I mean, it's already been kicking in. Whether or not it continues all 4 months like it historically has done remains to be seen. But it's at least good to have the knowledge of, that and the fact that we do tend to see the market do, or at least the growth area of the market do better over the next 4 months. All right, we're going to take a look at the chart of the day. Before we get into that, I do want to just remind everyone, if you do like these segments, the chart of the day, and you want to get more information on a regular basis, we do offer our Earnings Beats Digest, which is a 3 times a week newsletter, which essentially we're focusing on a chart of the day 3 times a week, Mondays, Wednesdays, Fridays. If you type in your name, email address, hit that subscribe button, we'll make sure we get the chart sent out to you. And this morning we talked about sentiment. And this is really a topic that's near and dear to my heart because I think sentiment is extremely important in terms of determining the future direction of the stock market. When everybody gets overly complacent, it gets to extreme levels, that makes it really difficult for the stock market to go higher because everybody's bullish. If you're bullish and you got money to put to work, you put it to work. Pretty easy. So if everybody's getting bullish, what does that mean? It means everybody's bought. Where's all the money going to come from? It doesn't mean you're going down because you've always got new money, 401ks, pensions, and so forth. You've always got new money, some new money coming in. But those who have all of their prior savings, anybody, when you're really bullish, has already invested. And so that makes it more difficult, more challenging for the market to keep moving ahead. And if you have other warning signs showing up at the same time, it can be devastating, as it was in 2022. History tells us that sentiment is a tremendous predictor of tops and bottoms. And it was again at the beginning of 2022. And I think it is again, or I thought it was in the middle of 2022. We finally started seeing sentiment turn extremely bearish in May and June of last year. In June, mid-June is when I called the bottom. We ended up going a little bit lower in October of 2022. I think we traded maybe 5 days on the S&P 500 below that June low where I'd called. So I think the bottom call was a pretty good one. We've been up since then, and a lot of it, in my opinion, has to do with sentiment. So what do I mean? All right, well, hold on, bear with me 1 second, because I'm bringing a couple charts where I have some, I've got this screenshot that I took. This is essentially a chart that I put in an article that I wrote over at Stock Charts yesterday. But this is what I call the Freightliner of sentiment indicators. It's the 253-day moving average of the equity only put call ratio. Now, why 253 days? What is that? Well, 253 days, first of all, is the number of trading days generally in a year. Trading days. So we got 365 days in a year, 366 with leap year. But generally, we've got 253 of those days that are trading days, Monday through Friday, non-holidays. The equity only put call ratio, you can see on an annual or on a 253-day simple moving average basis, tends to go in a certain direction for an extended period of time. The market goes from being way complacent, way too bullish, to at some point down the road becoming way too bearish, way too pessimistic. And so here, when we're up high, we're way too pessimistic. And when we go way down low and we roll over, that means we're way too optimistic. And then we get all the way up here. This was 2009 during the financial crisis. We got way too pessimistic, and that was a bottom. Then we rallied, went down to 2011. You can see in 2011, we had a pretty significant drop. After that, we'd gone too complacent. Then we got too bearish, too pessimistic right here, and the market continued going higher right there. Then you come down here and you get too bullish. And while this is moving higher, notice the market goes nowhere. Then in 2016, middle part of 2016, we got too bearish. What happened from there? Big move up while this was resetting. Then we get too low. We had a lot of choppiness, 2019, 2020. Trade war, pandemic. It was a pretty rough period to try and negotiate the market. But overall, we rolled over and we started becoming more complacent and more bullish than we had ever been since we've been getting these equity only put call ratios. At the end of 2022, end of 2021, beginning of 2022 is when this Freightliner first started moving up off of these ridiculously bullish levels. I mean, ridiculously low. The average 1 year equity only put call ratio, essentially, we saw these bottoms in the upper 0.50s, 0.58, 0.59, 0.60. That's where all these had formed in the past. We went all the way down to 0.46. And we were getting daily readings down here that were just consistently in the 0.5, 0.4, even into the 0.3s. We had never seen that before. That's what we had going into 2022. And that's why at Market Vision 2022, I said, the worst problem in the market right now going in is not inflation, not interest rates, not the Fed. It's not a possible recession. It's sentiment. Where's the money going to come from? I mean, we had people getting involved in the stock market, never been involved in the market before. So much money pouring in. You know, kids, $200, $300 to invest, thinking, I'm just going to make myself a mint. They were throwing their money in. There was no money to come from anywhere. We had to go down. And we did. And now look at where we are on this chart. We are all the way back up at, well, this is a little bit inflated. We don't have time to get into why, but November and December, there were some readings that came in, probably about 10 of them, that were very inflated. They were not retail trader related. They were more professional trader related. And what we're trying to do is gauge retail traders and their psyche. So when I say it, we needed to get rid of it, we needed to get rid of it because it was clouding the picture. There were a lot of puts being played in November and December when the market was rallying. And that, in my opinion, part of that is what held back a lot of the growth stocks in the late fourth quarter, November and December. That's why the NASDAQ didn't go anywhere. The biggest market cap stocks in the NASDAQ were the stocks where professionals were buying puts. And as a result, when you got a lot of money going in on the put side, market makers a lot of times have to short the stock. And when you're shorting all the top market cap weighted stocks, it's gonna be hard for those stocks to go anywhere. So there was a lot of that going on in November of December, which is unlike anything I've ever seen. And I've been studying the put call ratio since I started it. Never seen anything like that in terms of the individual daily readings. There would be days the S&P 500 went up 1.5%, 2%, and we saw readings of like 1.5, 1.5, 2 on the equity only put call ratio. I mean, it was crazy. So anyway, got to rule that out. Really, the number I come up with when I adjust this is probably around 0.69 rather than 0.73. But the point's still the same. When this rolls over, it's not going to be good for the bears. Because as we start to come back down, look at this. We came down here. The market went up 53% in a year and a half. We came down here. The market went up 47% in 2 years. We came down here. The market, actually, I didn't even move. I should have marked this one. This was a pretty big move as well. We came down here. We went up 98%. Now, that was coming off the 2009 low, but we went up 98%. By the way, we're coming off pretty significant pandemic low or pandemic related low. Here was the pandemic low, then we went up, and we still had all the inflation, which I believe came from the pandemic, to set that cyclical bear market low in 2022. But here we rolled over. So my point is, when this rolls over, and it's going to fairly soon, history tells us we want to be long. And the reason is, once you get to this level, everybody has sold. Everybody has sold. not literally, but you got all the new money still coming in from 401ks, and everybody in the market, most everybody, has sold because everyone's so bearish. You don't say, I'm bearish. You don't go out and buy a bunch of puts and then turn around and go buy stocks. Makes no sense. These folks are so bearish in the market right now, which is great. Anybody who's followed me knows the beginning of 2022, I said we needed to get to a point when we were way down here. We needed to get to a point where people that were so gung-ho about the market in 2021, we needed to get to a point where they never wanted to see another stock again. And this is helping to do that. That's about where we are now. All right, second part of this that I wanted to show you. It's right here. So this was the November, December. I'm just kind of blacking this out. Okay, it's red, not black, but I'm kind of covering it up because this was just, these readings were crazy. And keep in mind, this right here, this pink line, this is a 1 month average. This isn't the individual daily readings. We had a 1 month average go over 1, which is ridiculous. We've never seen that ever in the history. During a period when the stock market was going up, the end of 2021, we had the S&P rolling to the upside. And yet we had all these people playing puts. Well, it wasn't. It was actually much lower than you might think because of the hedging that was being done by many professionals on just a handful of stocks: Apple, Microsoft, Nvidia, Tesla, the Amazon, those types of stocks. And that's what was holding back the NASDAQ. Now, so what I'm saying is that 253-day moving average that we're looking at right here, the blue line, that's kind of flattening right here. And I think it's going to roll back. It's going to start to roll over. Notice that the 1 month readings are now starting to be below the 1 year readings. Notice during this entire uptrend, the 1 month stayed above the 1 year. Now we're starting to see more and more action the last 3 months with the 1 month below the 1 year. If the market goes up and this comes back down again, as this comes down in May, it's going to start replacing highs that we saw in May last year. This was the 21-day moving average in May. We finally reached 0.72 then, and we're sitting right now 0.718 on the 21-day moving average. So as we get toward the end of May, a lot of these readings, these earlier readings, late April, early May, are going to start being replaced by higher readings that kept the 1 month moving average high for quite some time. So if this starts to roll over at all, we're going to see this 253-day moving average start to roll over. I think it's going to happen later this month, but it's probably going to start fairly slowly and then roll over. And I think by the time we get into the fourth quarter and start replacing these readings, that is where this line, this 253-day line, is going to start going straight down. And when that happens, the market's going to explode. So I think we're going to do okay over the summer. I think fourth quarter, we're going to be moving much, much higher. Anyway, that is what I had for the sentiment chart of the day. Actually, 2 charts, little bonus chart there. And again, if you're interested, if these types of things, I mean, usually it's stocks. I'm usually looking at an individual stock with these newsletter articles. But sometimes I like to show, you know, our entire community, the big picture, some of the things that they're probably missing, mostly because they're not a member of Earnings Beats, because we keep our members informed of all of this stuff, including all the manipulation that's been taking place over the last year. Wall Street, the big Wall Street firms have been moving into growth stocks for months. And sometimes it takes that long to get all the individual investors to finally convince themselves that the market has no chance of going higher, and they sell. And then you've got the big Wall Street firms, their market making units, gladly picking up shares. And now AD lines just going up, up, up in 2023 as the market starts to move higher. Got so many people still not believing. I mean, just read my comments on my YouTube post. It gets, you know, somewhat hilarious, unfortunately. And there's 2 sides of every market. I'm not saying the market can't go down, by the way, but it's been going up for 6 or 7 months now. And yet the excuses for why it's going up from all the bears keeps changing. It started out as short covering. Hopefully everyone realizes by now short covering doesn't go up for 7 months. Short covering might go up for a week or 2, not 7 months. So I think that one's been put to bed, hopefully. A lot of it now is breadth. You know, the inflation talks died down because inflation's starting to come down. Market's been going up, so you can't argue that anymore. Right now it's about recession, or it's about breadth. It's about whatever you can come up with to try and support that bearish theme. What I simply say is, you know what? If the market rolls over and it gets bearish and there are reasons to be bearish, I'll turn bearish. It's hard to turn bearish when money is going into growth stocks and the market is going up and putting in higher highs and higher lows. Why do you want to be bearish with that? We're above the 20, which is above the 50. At least wait until things roll over and start to show something bearish. That's where I stand. All right, we've gone past 9:30 mark. I spent a lot of time on that sentiment, but I think it's worth it. I'm going to go ahead and just go back to the dashboard. Let's see where we are, see if the market's holding on to its gains or if the Dow's gone back down 74. NASDAQ, though, up 13. We got the VIX up 5.5%. That's back up almost to 18. 20 is the big level there, by the way, on the VIX. So as long as the VIX stays below 20, I think it's going to be hard for the bears to really get control of the action. S&P 500 down 2, so it's pretty much flat. If we pull this up, you can see it was up earlier. Now it's come back down a couple points. NASDAQ up earlier. That's come back down, but still sitting up a little bit higher on a percentage basis. Small caps, mid caps, both up fractionally. So we'll see what happens the rest of the day. But at least starting out, we were in positive territory, got a little bifurcated action now. Let's see how we finish the week. I will say, though, that we do have a lot of big things behind us now. So there's going to be less to really drive the market. I think the biggest thing for me is, does the growth area, do the growth areas continue to outperform value? Because I don't, if you're looking for a recession ahead, recessions kill growth stocks because it's the anticipation of their earnings going down. They revise earnings estimates down. And when they do that, valuations come down. So it makes no sense for growth stocks to be leading the value stocks right now. And it's actually occurring at every level. You might think it's just large cap. Small and mid cap stocks are going down, and growth and value are going down or underperforming, but value is way underperforming growth. Mid cap growth beating mid cap value. Small cap growth beating small cap value. It's the value stocks that are being sold more on a relative basis. Sector leadership year to date, 3 aggressive groups are killing everything else. That is not a market that's setting up to go lower because of a recession. Sorry, it's not. I can't get bearish when that's happening. Call me perma bull all you want. If you call me perma bull, obviously you've only listened to me for the last, 6 to 12 months, because I was as bearish as anyone when we were at the top in beginning of 2022. I was sounding the alarms way before everybody else. And I was bearish for 6 months to start the year. We'd rally and I'd say, don't trust it. We're not going up. It's a bear market rally. There are plenty of those videos out there if you want to check those out. I call what I see. I don't call what you want me to call. Anyway, I'm done. That's it. Have a great day, everybody. I'll be back over at Stock Charts TV tomorrow morning at 9 a.m. for your next Trading Places Live, although technically it is a recorded version. But I'm planning to look a little bit more at the small and mid caps tomorrow and show you what I'm seeing in the growth versus value space. So make sure you tune in for that. Anyhow, have a great day, everybody. Happy trading.